morning everyone and welcome to Morning Markets. Now on screen you'll notice that the main mover in broad indices overnight was in emerging markets, and this is largely down to more positive news emanating from China with regards to their zero COVID policy. At the margin it appears that the days of the past, the severe lockdowns, the government there may be moving away from imposing the most severe restrictions on areas which are having COVID outbreaks. This would be positive for internal demand within China and would allow market participants to look through the winter and hopefully into an era of reopening in the spring. And that sentiment is really filtering quite aggressively through Chinese asset prices and into broader emerging market indices. And we'll watch that closely and update you further should more substantive evidence emerge from government. Now the main event for today, and likely possibly one of the most main events for the rest of the year, is a speech from Chair Powell, the head of the US Federal Reserve, later this evening. Now the speech is going to focus on the broader US economy, so not just growth, but inflation and the labour market. Now this is important because it's the first speech that the chairman has given outside of the conventional monetary policy setting in 3 months. It's also against the backdrop of falling inflation in the US. For the first time in 18 months, the US has seen a substantial fall in headline CPI and is likely to see further substantial falls into next year. So the mood and the setting that Chair Powell provides this evening is very important. We should contextualise that it's likely that he sets the scene for further interest rate rises from the US Federal Reserve Monetary Policy Committee, even as inflation declines. He's also likely to focus particularly on the US labour market and the strength of the US labour market and how this poses a challenge for the Fed to try and get inflation back towards their 2% target by the end of next year or possibly into 2024. So the message from Chair Powell this evening is likely to be more hawkish than the markets had expected previously. And that is possibly why, as you'll have seen on screen, we saw bond yields in the US rise yesterday and equity market performance has been somewhat subdued. There is worries at the margin that Chair Powell will really push against any expectations and dovish hopes from the market. Now why this is important is because of the realised inflation we've just discussed falling in the US. Recall that at the start of the month, the Monetary Policy Committee of the US were very hawkish when they hiked rates by plus 75 basis points. And they did indicate that whilst the pace of future hikes will slow from the meeting in December onwards to possibly around 50 basis points, the work is not yet done in bringing the economy back into equilibrium. So this means further rate hikes ahead. But what we've had since is a downside surprise in US inflation for the month of October. Now that is important because US inflation has actually been falling since late summer. And it shows that there are these disinflationary pressures building across the US economy, which will take us into 2023. And this week we're seeing similar from CPI prints in the Eurozone. We've seen downside misses in Spain and Germany yesterday, and we've seen a much lower CPI print from France this morning, all for the month of November. And in fact, Spain and Germany are showing signs of short-term deflation. That's allowing headline inflation to roll over quite aggressively. So there's a clear theme of falling inflation building across the Eurozone and the US. But this is unlikely to move central banks away from their hawkish messaging. They are acting with a lag to the inflation pressures which have built up through most of 2023. So as I've said, we're likely to see a very hawkish message from Chair Powell this evening and indicating that the Fed remain committed to bring inflation back towards target and that they perhaps expect unemployment needs to rise higher in the US than they had forecast just back in September. Recall that their forecasts were for unemployment to rise towards 4.5%. It's currently at 3.7%. So that might not appear to be a massive rise, just going round about 0.8 percentage points. But it would indicate that the rise required is more reminiscent of previous recessionary periods in the US. So markets will be very vigilant towards any numbers given by Chair Powell today on the desired rise in unemployment. And of course, early in December we get the ECB meeting as well, where again they have forecast that they may be hiking rates by plus 75 basis points again, despite inflation falling. So that really sets the scene for where we're going into the year end, which is genuine signs of market disinflation building. That is, the inflation peak is past us, and that we may be able to enjoy a period of much slower growth in price pressures, which would feed into headline CPI across Europe and the US rolling over materially, perhaps heading below 5% sometime early in 2023, but that central banks remain committed to hiking rates further and are certainly not considering any form of rate cap until inflation pressures have largely diminished and we're back towards target. That's why we may see some higher bond yields in the short term as markets react to these more hawkish messages from central banks. And it may take equities some time to recover back to the levels we saw last week. That is, there has been a substantial rise in equity prices over the month of November following that miss in US CPI at the start of the month. So there will be much to digest from markets as they absorb the message from Chair Powell this evening. So please do join us tomorrow, where our colleagues will update you on the nuance within that messaging and other data releases which happen through today. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.